economists say it's almost certain that rates will stay on hold at 3.6% after stronger than expected quarterly inflation numbers last week. Our business correspondent David Taylor is outside the Reserve Bank. Hi, David. So is there any chance of a move?
Oh, good afternoon, Ros. Look, there is virtually no chance that the Reserve Bank will either hike or cut interest rates today. It'll be a rates on hold decision. But clearly, the Reserve Bank, what we'll need to find out is whether the Reserve Bank is genuinely worried about the recent surge we've seen in inflation. We had both core and underlying and headline inflation all either at the top of the Reserve Bank's target band of between 2 and 3% for inflation or a little bit above. Now, all eyes were looking at, or at least blaming, electricity prices in the last September quarter inflation data. But the fact is, despite moving up to 4.5%, the labour market is still considered relatively tight. That means consumers have money in their pockets and are still bidding up prices at the stores. So there is a costs element to this, which is pushing business costs up, and they're passing that on to customers. And of course, there is still a little bit of demand in the economy. So today, the key question for the Reserve Bank governor is, with this slightly elevated inflation, certainly going in the wrong direction, they were hoping it would be going down, it's going up. Just how much further does the Reserve Bank think inflation will be increasing? And Ros, I have to say, with low levels, very weak levels of productivity and rising wages, which raises business costs, there is some element of, concern that the inflation rate, the underlying inflation rate, will continue to push higher, which would, as some economists
apologies,
like
I'm going to interrupt you now as we
have
have a decision and an announcement from the Reserve Bank. In breaking news, as expected, the Reserve Bank has left interest rates on hold at 3.6%. Let's bring in Adelaide Timbrell, who's a senior economist at ANZ and joins us now from Melbourne. Adelaide, good to see you. So it was last week's quarterly inflation numbers, as David Taylor was saying, that made all the difference here. Where are inflationary pressures coming from?
Yes, inflationary pressures were broad-based in the Q3 data. What we saw was underlying inflation, which takes out some of the volatility, including those electricity price increases, and focuses on the longer-term trend, was at 3% per year. Now, the Reserve Bank's goal is to get to the midpoint of their 2 to 3% target band, which is 2.5. So a lot of things came into this Q3 CPI being higher. Things like property rates and charges went up a lot more than usual. We're seeing strong increases in rents for housing, in education. There was also been, over the last few quarters, some stronger increases in food. I know anyone who wants to buy eggs or coffee over the last 12 months would have noticed that. So we're also seeing persistently high inflation in market services categories, which basically means anything where wages are really creating that drive in inflation. Average wage growth is a little bit ahead of where productivity growth and the economy is, which means we are seeing that passing through from businesses to consumers.
So for the benefit of our viewers, Adelaide, can you explain why these higher inflation numbers mean that the RBA didn't cut rates today?
Yes, when inflation is running a little hotter, it means that it's harder for the Reserve Bank to cut rates, because when the Reserve Bank cuts rates, a lot of people in Australia get their mortgages a little bit cheaper. Also, people with savings accounts earn less from keeping their money to themselves. This encourages people to spend more, save less, and take on more debt. When people do that, businesses get more money more easily, and they don't have to be quite as competitive about their prices, which means inflation can continue to run at that hotter rate. Whereas when the Reserve Bank keeps rates at that higher level, what it does is it just keeps people a little bit more cautious, keeps businesses a little bit more competitive, and that can help.
Rates on hold.
Adelaide, we're going to go back to Parliament House
I do
and
acknowledge
to the Treasurer who is talking about
many Australians would have wanted to see
rates
more rate relief at this meeting. But this decision was widely anticipated by markets and widely expected by economists. Now, it is the case that inflation is much lower than we inherited from those opposite, and that has given the Reserve Bank the confidence to cut interest rates 3 times already this year. And those 3 interest rate cuts do reflect the very substantial progress we've made in our economy together. When we came to office, headline inflation was 6.1% and rising. It's now around half of that. When we came to office, trim mean inflation was almost 5% and rising. It's now been within the target band for 3 consecutive quarters, albeit at the top of the target band now. If you look at around the world, inflation ticked up in September for every major advanced economy except the UK, where it was flat, but much higher than it is here. Now, Mr Speaker, once again, as I did in the answer a moment ago, I acknowledge and we acknowledge that even with this progress we've made, Australians are still under pressure. Those 3 interest rate cuts are providing a bit of relief, but we know that many Australians would have preferred to see more relief delivered today. We've got inflation down, we've kept unemployment low, the economy's continued to grow, the private sector is recovering in welcome ways, we've got real wages growing, and interest rates have fallen 3 times this year, but we always know that there is more work to do. Now, Mr Speaker, if you have a look at the forecasts which were also released with the Reserve Bank's decision today, you will see that when it comes to government spending in the Reserve Bank's own forecast, they've actually downgraded the contribution made by public spending in our economy. And I think that does torpedo some of this dishonesty that comes from those opposite about the role of government spending, and so I point that out, Mr Speaker, acknowledging the usual politics will be played by those opposite. But if those opposite want to claim that budgets are the decisive factor in interest rate decisions, then they've got to explain those 3 interest rate cuts this year, including 2 interest rate cuts which came after the budget in March. Mr Speaker, we will continue to work through the issues in our economy, the challenges in our economy, in the most responsible and considered and methodical way. We've made a lot of progress together in our economy. We know there's more work to do, and we've acknowledged that throughout.
Call to the Honourable the Leader of the Opposition.
Thank you, Mr Speaker. My question.
So that's the Treasurer, Jim Chalmers, there commenting on the decision by the Reserve Bank to keep rates on hold. That came out just about 6 minutes ago and was fully expected by the markets and also by economists. And one of those economists is Adelaide Timbrell, who we were talking to before that announcement from the Treasurer, or the comments by the Treasurer. Adelaide is senior economist at ANZ. So we were talking about inflation, Adelaide, but jobs numbers are showing some signs of weakening, aren't they? And if they do weaken further, could that increase the chances of a rate cut down the line? Because that would impact inflation, wouldn't it, bringing it down?
Yes, that's right. So the labour market is incredibly important for the Reserve Bank. In fact, they generally have 2 jobs. One is to keep inflation between 2 and 3%, and the other is to keep the unemployment rate as low as possible without creating an inflation spiral. So they don't want to see the labour market loosen too much, or basically too much unemployment, and then also too many people not getting enough hours. What they've said, though, in the post-meeting statement out of today's decision is that labour underutilisation remains at low rates. Now, that's just basically a fancy way of saying most people have jobs, and the people who have jobs mostly have the hours that they want. So they're still looking at the labour market as relatively tight, even though the unemployment rate has risen a little bit over the last couple of months. They're also saying that job vacancies are still at a high level. Now, when I look at the economy, when my team looks at the way things are going, we do see a bit of loosening in the labour market. Job vacancies, job advertisements are down, unemployment is up. So we do think that that will probably mean a little bit more loosening the labour market, which can be disinflationary. So really, really good for, your grocery prices, not so good, obviously, for those people who no longer have work. But it's going to be all about how the Reserve Bank actually assesses that and the level at which they become uncomfortable.
So when will we see the next move on rates then, Adelaide, and in which direction?
So the next move is much likely, more likely to be down than up. When really depends on the data coming forward. So there's a few things we're going to be looking at really closely. The first is how inflation goes. Now, we do not expect inflation to continue at this high rate, and neither does the Reserve Bank. They said that part of the reason we saw such high inflation in Q3 was due to temporary factors. Look, when I look at the data, and I've looked at all, 85 small tiny categories of the CPI. It's very true. There are those temporary factors in there. There's things like property rates and charges. They were up 6.4% this year. Council's not going to do that again in 3 months, right? Oil prices have moved up a little bit. That's not something that's going to be sustained. All of these things mean that our next inflation number is going to be looking a lot better. And the labour market, while it is loosening, is still pretty good compared to, say, before COVID, where we had those unemployment rates of above 5%. So it's going to come down to how those numbers evolve and then how the Reserve Bank interprets those numbers as well. At this stage, what they're saying is, hey, these first 3 rate cuts, they actually haven't fully had their effect on the economy yet. We don't necessarily think, so the Reserve Bank doesn't necessarily think that rates are in restrictive mode, i.e. slowing inflation down actively. So they're going to be taking a very, very cautious approach, and that's a quote, cautious approach to monetary policy going forward. I think that's why this was a unanimous decision between them to pause the cash rate in light of all of these factors.
Adelaide Timbrell, thank you so much for being with us.
Thank you so much for having me.
Let's go back to our business correspondent now, David Taylor, who is down at the Reserve. David, you've been looking at the statement from the Reserve Bank that comes out with the rates announcement. Any surprises in it?
Yeah, indeed there are, Ros. Quite a few. The Reserve Bank has made a point of saying that the increase that we had in both underlying and headline inflation uses the word may, and I know that's just one word, but it's important, be temporary. So the idea, and as Adelaide Timbrell was just pointing out, the Reserve Bank has a dual mandate. One is to look at full employment, the other one is to look at inflation being sustainably within the target range of between 2 and 3%, which the Reserve Bank pings at about 2.5%, right in the middle of the target band. So if Adelaide Timbrell is correct in that there is potentially some further easing in the labour market to come, then the next move in interest rates would be down rather than up, or at least unchanged. So the next question is, well, what's happening with inflation? And the statement makes it pretty clear that the rises that we've seen, and I've mentioned that the electricity prices are largely to do with that, are not chronic, are not endemic to the actual inflation rate. And indeed, Ros, the Reserve Bank has said in the statement that its forecast for underlying inflation for later this year and into next year is 2.6%. So it says that underlying inflation will creep up potentially further from here, but in terms of the long term, it's coming back down to 2.6%, which, as Adelaide Timbrell suggests, there could still be an interest rate cut by the Reserve Bank next year. Certainly not in December, but what the Reserve Bank is saying is that it expects future quarterly inflation results down the track to revert back to where it thought. The last thing I'll add, Ros, is simply that, again, this word uncertainty comes up many times in the statement. And the Reserve Bank, like many economists, don't believe that the Donald Trump Xi Jinping trade wars are over, and indeed there are signs in financial markets at the moment that there's the potential for some dislocation in financial markets coming up. That, of course, could flow through to the economy and jobs. The Reserve Bank is flagging that several times in the statement. So before you crossed to me before the decision, I would have said rates on hold indefinitely until there is a rate rise. Having read the statement, I'm going to change that to saying that rates are on hold, certainly for the near term, but the next move, in my view, is more likely to be down now.
OK, David, thank you.